Okay, we'll look to get started in discipline as it is 12. Thank you for joining us today as Credit Risk Monitor presents 1 year in best practices for staying ahead of the COVID-19 global debt explosion. This is the second part of a two-part webinar series. The host for the program will be Mike Flum, Credit Risk Monitor President and Chief Operating Officer. Our featured speaker today is Chris Chach, Credit Risk Monitor Vice President of Client Services. Our program is expected to last 1 hour in duration, with the final 15 minutes dedicated to Chris and Mike answering some questions from attendees. If you wish to submit a question, you can do so via the QA option in your Zoom menu. Chances are we'll be answering some of the submitted questions as we go, so be on the lookout for an answer. Any unanswered questions will be addressed in the final minutes of the program. During the program, we'll also be conducting some quick polling, so be sure to participate when called upon. Finally, we are asking all attendees to fill out and complete a brief exit survey as the webinar concludes. If you would like to get in touch with our speakers after the conclusion of the webinar, we will provide you their contact information upon request. Chris and Mike will touch on
Nick, before you keep going, I don't think you're sharing. So.
Oh. Thank you. Must have dropped off. My apologies. We good now?
Yeah, it looks.
All right, thank you. Chris and Mike will touch on various subjects, including but not limited to using the FRISC score, our best-in-class private company solutions, benefits of trade contribution, and how API and enterprise agreements make credit data analysis that much quicker. As mentioned, Client Services Vice President Chris Chach will lead today's conversation. From trade contribution to deeper MD&A analysis and all points in between, he will illustrate the proactive steps taken by our very best clients to avoid bankruptcy risk and how his team can tailor a perfect approach for your business. Also speaking will be Credit Risk Monitor President and Chief Operating Officer Mike Flum. Mike is also a passionate advocate for data science and the doors that artificial intelligence is opening to help our clients make informed decisions about the sustainability of their portfolios. And with that, I will hand it off into the very capable hands of Chris Chach.
Thanks, Nick, and thank you everyone who joined us today. We're extremely excited to present to you some of this information. There's no doubt the past 12 to 14 months have provided a lot of us with some unexpected troubles and events related to COVID-19, especially those who are concerned with monitoring the financial risk of their counterparties in the business world. And, you know, in the seat that I'm in and my team in client services, we're just in a really unique position where over the past several months, we've had some really sophisticated clients approach us and ask us to support them in better leveraging, you know, our data and our information in the context of their subscription. You know, in the previous webinar, those who attended with Dr. Gomez and Mike, you know, they discussed the macroeconomic environment over the past 12 months and really highlighted the power and methodology of the FRISC score. And it's to our great pleasure that our subscribers have really adopted the FRISC score as their first line of defense when sourcing and onboarding customers and suppliers. So for example, you know, as we've discussed with a lot of our clients, we've had clients that have kind of retooled their credit procedure policies to focus more on the FRISC score. We had a client who approached us and were retooling their credit application process where when a customer came in with a FRISC 5 or below, it caused a series of events to occur where the credit department of that client would take a deeper dive and leveraging some of our reports and some other information to really do a full analysis of that client. And a similar approach on the procurement side where, you know, when a potential supplier comes in at a FRISC 5 or below, you know, there are certain steps that were taken by that client to potentially source alternative suppliers as a contingency plan, or just take a deeper dive and have a further conversation with that supplier about the longevity of their company and the current financial environment that they're in. Given that most of our subscribers' receivables are heavily influenced or covered by the Frisk score. Typically, we see 50 to 55% of our customers' AR covered by the Frisk. Most of our clients have now been consciously moving away from payment-based models, financial-based models, and the old internal scoring models that they use to monitor financial risk to focus solely on the Frisk score for public companies. As we get into the next slide, I'll show you some reasons for that.
One thing before we jump over on that, obviously for anybody who did not make it to Camilo's previous presentation on the Frisk score, there's a reference to it kind of at the back end of this, but we go into a lot more in depth on these four particular methodologies that we're combining non-linearly. So I just wanted to make sure everybody was aware. If you did miss it, it was a great presentation. Camilo did a great job kind of elucidating all of these factors and why they really combine in such a great method. So I'd encourage anybody to check that out if you have extra interest.
Gentlemen, we actually have our first of two poll questions, so I'm going to launch that right now. And your first poll question to everybody is, how important is the timeliness of scoring models in your process? It's a scale of 1 to 5, 5 being extremely important. And we'll let that run for a minute. This is what we like to see. Not a lot of 1s and 2s, lots of 4s and 5s. About 50% have voted, so please, if you feel like voting, do so within the next 10 seconds. Okay. Our second poll question, which I will launch now, is, do you use the same scores to evaluate both your public and private companies? About 30 more seconds. And about 5 more seconds, please answer. Okay. Back to you guys.
Thanks, Nick. So over the past several months, the client services team at CreditRiskMonitor received dozens of requests per day, with subscribers inquiring about the discrepancy between our Frisk score and other scores in the marketplace, including our own DBT index that we provide and the Altman D double prime score. And it's really caused us to work hard to help our subscribers understand when and where they should be using these scoring models and how best to apply them into their day-to-day process. You know, the chart that we're displaying here gives you kind of a waterfall approach of priority on what you really want to rely on. So obviously for publics, you want to rely on the Frisk score. And if you can obtain financials on a privately held company, certainly we can provide a Frisk score and a Z-score on that company as well, which we'll get into. In the event you can obtain financials or the company is hesitant to share them with you, but you still want the business relationship, you can rely on the PACE score. For large North American private companies, we cover roughly 100,000 companies with that score. And since that score is driven mostly off trade data information that we capture, it really relates to the probably the 100,000 most important companies that are privately held U.S. to our subscriber base. And then finally, in the event that neither one of those items are available, you can rely on a payment-based model. But in our conversations, we've really cautioned our subscribers to consider that the payment scores are really only capturing past behavior or past experiences and summarizing that information, while your frisk scores and pay scores are really looking at to future events related to bankruptcy and financial distress. So oftentimes you will see conflict between payment scores and financially based models, or even payment scores and the pay score in this instance.
Yeah, and Chris, to build on that, I think it's really important to kind of look at that update period too. I know we're mentioning, obviously the frisk being daily versus PACE and payment scores being monthly, but one other factor to kind of consider with that is anything that's based upon trade information is always going to have some corresponding lag to it. This is based upon people closing out their accounting files and actually then sending that information over to bureaus to go ahead and do roll-up analysis and create scoring models from it. So there's typically going to be anywhere from about 3 to 6 weeks of delay between a posting of a monthly close and an actual score related to that month. So in addition to it just being offset by daily versus monthly, there's also a lag factor that needs to be taken into account. The other thing I really want to point out, and Chris mentioned it, is the difference between a forward-looking and a summary score, like for instance the DBT index score or other payment scores out there, like PAYDEX, for instance, from DNB. And the point is, in many of these cases, what you're finding is that payment scores that are average dollar weighted are really just summaries of past performance. So they give you an idea about trend, but they're not forward predictive, and they're certainly not going to tell you what's going to happen in high volatility considerations. Obviously, this pandemic represents an example of a high volatility condition where past payment performance was not indicative of future performance. In comparison, scores like the frisk, scores like the PACE are actually folded into what's called logistical regression models, and they actually are making a prediction about future behavior. So that's really important. We'll touch on it a lot more when we get into the ideas related to some other things such as like CECL compliance, but that forward predictive capacity is really important here.
So I also want to really stress and take a closer look at using a model strictly based on financials could also leave you without outdated information and leave you vulnerable when you're making key business decisions. So what this chart is going to illustrate for everyone is the Z-score movement versus the frisk score movement between January of 2020 and April of 2020. And what you can see here is the dotted line representing the Z-score, the solid line representing the frisk. There are movements within the frisk score as the frisk score reacted to some of these financial elements that the Z-score was just not capable of picking up on. So if you think back in context, the financial impact of COVID-19 really began to materialize between mid-March and mid-April of last year. The downside of relying on a model like the Z-score is that those changes, if any, wouldn't materialize well until July or August by the time a public company had filed their quarterly financials. You can see there's a huge delta here of nearly 2,000 companies that were impacted that were not reflected in the Z-score, but actually reflected in the CreditRiskMonitor frisk score. And this is really a credit to the additional components that we include in the frisk score outside of financials. Again, we're looking at stock market capitalization and volatility, agency ratings when available, and subscriber crowdsourcing, which we'll get into in a moment.
Yeah, and Chris, thanks for pointing that out, because I know I just talked about the lag within payments, right, compared to things like the frisk score, but it's obviously also there when you're looking at just a financial statement model as well. We're using the Altman Z double prime kind of as a stand in that, but there are lots of different financial statement models that you could be using for this. The point is, financials are also going to post at a delay, right? The information that you're looking at that's posting up at the end of Q1 is really just reflective of the performance at the end of 19 in this particular condition. So you're not going to see any sort of movement in those scores until easily a month after the Q1s for those large businesses that have filing requirements. Meanwhile, the entire group is really going to be within that 3-month period afterwards. So you might not even be getting that indication until really the end of June. And in this case, you can even see there wasn't really very much movement in terms of the number of businesses that were rated high risk within the Altman Z. So just another thing to keep in mind. You can keep going, Nick.
I think a lot of the conversations we had too always dwelled on, I guess, the negative effects of this environment and leveraging these scores to really worry about credit exposure. We've had some really fascinating conversations with users about how the timeliness of the Frisk score could actually positively impact their business for companies that are considered low risk, or those companies in the green zone, as some of you are familiar with it. So in sharing conversations with clients, we've identified that many of them have leveraged the information provided for companies that were early emergers out of the risky category during this COVID crisis. And companies have adapted by applying their promotional dollars, to those lower risk companies, because they feel like those clients will have more longevity and a more stable relationship with them going forward. But also those that leverage the Frisk score versus some of their competitors who may be only relying on a financially based model are able to pick up on positive changes well before the Z score was. So again, this allows them to be ahead of the curve. And I think lastly, one great example we saw is we had a couple of clients actually integrate this information into their sales enablement tools and their customer relationship management platforms. So their sales representatives were focusing more on companies in the low risk and medium risk buckets rather than looking at prospects that were showing financial doom and gloom. We're talking about collection efficiency on this, more stable relationships, and just better sales prospects for the long term.
Yeah, and I think it's important to even note about that. This is another way that we've seen it kind of used in an interesting method within that sales and marketing component, is actually queuing in, the sales team on where to apply promotional budgets. If you're able to kind of give people discounting, it makes more sense to give discounting to a client that has, staying power or stability financially, where you're not going to be caught with a receivable risk. And so that was another really interesting kind of external use that we hadn't really thought about too much until it started getting brought up by customers. So really interesting to kind of see the way that people are kind of flipping this, making it, the double edge of the symmetric effect of being able to recover faster as a way of actually, reaping opportunity out of what typically looks like crisis. So.
Now, we touched on the financial aspect of this. So if we go to the next slide here, we just want to highlight the dangers, and many of you have experienced this, the dangers of relying on a payment-based model to assess public company risk. So there's some examples here that we're going to go through, such as Seadra Limited. You can see their DBT index was very strong at the time of filing for bankruptcy. The next example would be Feral Gas, which should be available on these slides. Companies like Mallinckrodt as well, all exhibiting really strong DBT indexes at the time of filing for bankruptcy, meaning they're paying their suppliers and vendors on time, despite the Frisk score showing them as high risk and despite their DBT index representing something different. Now, why do they do this? Roy, why do public companies display this behavior, and how do they have the ability to do so? So generally speaking, what we're looking at is the idea that CFOs are quite aware of the payment-based scoring models that are available in the marketplace. And they understand that if they're able to pay suppliers and vendors on time, it serves two general purposes. Obviously, one, keeping the stream of goods and services coming into the company to create revenue is one. But secondly, by paying on time, these payment-based models in the marketplace react and cloak the idea or mask the idea that a public company is actually exhibiting financial distress. Now, how do they do that? Well, they have access to capital markets with the ability to float bonds or raise cash effectively to pay suppliers on time. I think the most extreme example, or the poster child for this situation, was Briggs & Stratton, who filed in July of 2020. And the reason why we cite this as an example is that both alternative scoring models or alternative methodologies to scoring, whether it's payment-based or solely financial-based, actually lagged in the Frisk scores analysis or pickup on financial distress. So you can see here, going back to April of 2019, they were in the red zone. They were considered a 4. Again, that's where most of our clients really come to do their work. When they see a company hit that threshold, they take a deeper dive and start to change their credit policies or their relationship with that business. And you can see the Frisk score degrade over time into a 1. All with that said, the DBT index, they were paying everyone promptly, hundreds of millions of dollars in payables, getting paid to suppliers and vendors on time. And eventually the Z-score did react. You can see in the quarter before Briggs & Stratton actually filed, the Z-score went from positive to negative. But here's the catch. That Z-score didn't post until May 8th of 2020, just 52 working days before filing for bankruptcy and 29 working days after the close of Q1. You know, that doesn't permit credit managers to be outside of that preference period for collection after bankruptcy. So if you were relying solely on payment data or a financially based model here, you're really dead in the water. Meanwhile, the Frisk score, again, well out in advance of this issue, and as early as March, they were in the 1 zone, which would have given you enough time, you know, to prepare for any kind of fallout with the relationship or the inevitable filing of bankruptcy for Briggs & Stratton.
And just to add on to what Chris was saying, I mean, obviously we showed you guys a few kind of examples of this cloaking effect with payments through the DBT versus the Frisk. I just wanted to highlight, you know, we did some analysis looking back at, you know, from beginning of 2019 all the way through the end of March 2021. And what we found was that in 43% of the bankruptcies that occurred without an emergence during that period, 43% of them had this green DBT index versus a red Frisk score. So it's not an isolated example. This is really occurring across the board. The other kind of interesting thing to look at that is look at the AP available to those businesses 6 months prior to filing and the month that they filed. And in that category where you do have that green DBT versus red Frisk scenario, on average, they were able to increase their payables by about $10 million in that 6-month period. In comparison, those that did not exhibit that behavior, you know, didn't have the green DBT and the red Frisk, but saw either you know, mid-level DBT or a red DBT, they actually saw their AP reduce by on average about $12.5 million in the 6 months. So it's clear that, you know, as a methodology, this reliance on the payment scores is clearly being factored, because when there's an indication of delinquency from the payables, you know, people are cutting back on credit. You can't expand your AP in comparison to those that are able to kind of tap this and continue to send that positive signal. So it's another reason to, you know, not rely on these payment scores, specifically with public companies where, you know, they have access to these capital markets, like Chris was saying. I mean, don't get hoodwinked by CFOs that are, you know, actively trying to send signals to the market, both just to credit managers for working capital, but also to the investment community, because they're also looking at the score. So there's a lot of incentives to not send those negative signals out, and they're going to do everything they can to manage their cash flows. So things to keep in mind.
Yeah, when we looked at that research, Mike, it was kind of mind-blowing to think, just on a very basic level, that companies that were on the verge of bankruptcy were actually able to increase the amount of credit that was being extended to them right before bankruptcy. Is really a scary, scary thought. So again, really important you pay attention to that information. Of course, we break down all that information in our financials on our company website, you know, when you access the subscription.
Yeah, I mean, the most incredible case was Dean Foods. I think they expanded by close to $135 million over that period of time. Yeah, unbelievable.
Yep. So I'd be remiss if I didn't mention the importance of our subscribers and their impact on our scoring model. As many of you heard us speak about, we have incorporated crowdsourcing into the Frisk score. And we've done this for several reasons, but, you know, credit professionals are really the unsung heroes of B2B transactions. You know, 25% of all corporate debt in the U.S. is accounted for by trade AR credit, essentially an unsecured loan in some instances. And credit professionals, as you all know, you guys have a substantial impact on the working capital of not only your corporation, but the corporations that you're selling into. You know, any collective change of payment terms by suppliers could be detrimental to a company, and in worst case, you know, cause for a bankruptcy filing. So for this reason, amongst many others, crowdsourcing became an important component of the Frisk score just a few years ago. So if you think about the current environment, a lot of these peer-to-peer relationships that you all have were probably difficult, to maintain, whether it's the credit groups you participate in or the industry thought groups you participate in. So you can consider the CreditRiskMonitor website kind of like a virtual credit group. So credit managers and risk professionals are essentially the most important source of asymmetric information into the financial risk of their counterparties. Your exemption from SEC regulation and fair disclosure permit you to bring information to our website that the financials or the Frisk score wouldn't necessarily pick up on without your input. So what we found after looking at 20 years of anonymous click patterns of our users is you all in your own right are predictive of a company's potential financial distress. You might hear something in the marketplace, something at a credit group, maybe something happens on a customer visit that causes you concern, in between filing periods or well in advance of what would materialize, when they file their financials. And we've been able to isolate and identify that your click patterns, again, and the volume of pages you look at on a specific company report are highly predictive of a bankruptcy. Well, how does this really impact you on a day-to-day? Well, this really impacts your workflow, because you can see on this chart here, what's really fascinating about the introduction of crowdsourcing to the Frisk score is before crowdsourcing, we were capturing 50% of all bankruptcies that occurred at the Frisk 1 and 2 level. Now that's pretty strong, but when we introduced crowdsourcing, that number elevated to 67%. And what that allows you to do as a risk professional is really have trust in the Frisk score that when somebody gets into that red zone, you have to come to work and you can rely on the model to, dictate some of your policies and procedures, but also prioritize your busy workflows on a day-to-day basis.
Yeah, and to add on to that, Chris, I know we covered it a little bit in the last lecture with Camilla, or webinar rather. But it's really important to highlight that top bullet. I mean, trade credit represents over 25% of corporate debt, at least in the United States, and that's 3 times the size of bank loans. So this is a huge component when you get into working capital. I mean, we all know from distress situations, if you're getting into inventory fire sales, that's not worth more than cents on the dollar. So when you really get into what's driving working capital, a lot of it is this differential between, AR and AP. And that's strictly the domain of kind of the credit manager, that extension. So I think it's important to also identify it is interest-free in comparison to some of the alternatives out there. So when you're really into those situations of high distress and you're trying to find ways to finance yourself, that's not available to you. If trade credit's not available to you, you're going to be finding, almost usury terms from banks or from hedge funds. And that's really not a way of keeping yourself in business, which gets, again, back to why it's so important for CFOs to kind of send these positive payment signals, because they know that at the end of the day, a lot of credit managers and a lot of credit functions are using payable based scoring as kind of that indicator. And so if you get caught up in that, it's very easy to kind of get fooled. And this is exactly why we improved, the Frisk score by dropping in this crowdsourcing effect, because at the end of the day, credit managers that don't get fooled about this and actually do the research, they really control the working capital of most of their buyers. So it's just important to kind of, celebrate you guys as a group, because when you get it right, you get it right. That's what we're seeing out of this improvement here. But to the same extent, just another indication of why it's so important to not necessarily rely on payment scores.
Gentlemen, before we go into our next section, we actually have another poll question, so I'm going to launch it now. And the poll is, we're asking everyone, do you review MD&As as part of your credit reviews? We'll give everyone a minute.
Just for clarity too, management discussion and analysis, for those that don't know the acronym, if you're unaware.
Just hoping the 40% that said no, that wasn't the case. About 15 more seconds. And time.
So over the past several years, it's been the collective goal of the account management team, our client services team at CreditRiskMonitor, to really help everyone get the most out of their subscription. So we started on, and I hope some of you have noticed this change, but we started on a highly elevated path of education and really trying to alert you to the riskiest situations in your portfolio and have everyone understand, where we can be of great benefit. And since that time, there's been several questions that have come back to us. And the general gist is, hey, Chris, hey, CreditRiskMonitor, what do I do when a company is Frisk 5 or below? Now, that's a loaded question because it's going to depend upon your industry. It's going to depend if you're on credit or the procurement side, or maybe you're even in treasury. It's going to depend on your risk appetite. It's going to depend on so many factors. But what we're able to do over the past couple of months is really compile some of the common practices from our subscribers to help them come up with some kind of methodology. So what we're going to show you over the next several slides is just an example of how you can really leverage, what we're speaking about. So for instance here, you get an alert in your inbox, which many of you get, or account manager reaches out and says, hey, this customer's a Frisk 2, it's been downgraded. What's the next steps? Well, one of the things we created to help you understand how the Frisk score has changed, but also communicate that information to key stakeholders internally, is the Frisk analysis box on the snapshot page of our reports. And this is available on any company who's a Frisk 4 or below, which is about 2 times the average risk of bankruptcy when they reach that Frisk 4 level for a public company. So you can just see here in this general example, we're just identifying the risk of bankruptcy, the fact that they're cloaking their payments, that the agency ratings are non-investment or quote unquote junk, total liabilities 10x larger than market cap, and that there's some financial distress in the ratios reported. So that allows you to take a step-by-step look into the company report based upon the way our website is structured and identify what these changes are and how you interpret them. All right, on the next slide, we talk about the importance of the MD&A. And this is a really important piece that complements the usage of the Frisk score and the usage of all the other information on our site. For those of you that access this, you know exactly where to find it. For those of you that don't, this is located on the left-hand menu on our site below the 3 different types of financial breakdowns we provide. You'll see liquidity and MD&A. What's really important about this is that it directly addresses a company's performance, liquidity, and capital resources, and the CEO and CFO of the companies making these statements are bound by personal liability. So there is no masking or cloaking or dancing around the fact that they might be on the verge of bankruptcy or have some severe financial distress in their organization. And now listen, the MD&A can be rather dense. So we've created kind of a cheat sheet here for subscribers to do a quick Control F on the website and pull out some of these key phrases: liquidity, going concern, negative cash from operations, default, borrowing capacity, just to add a narrative into all of the analysis that you're looking into and what you're finding to be troubling about a specific company. Again, mostly driven by the fact that these companies will be in the Frisk 5 and below zone and be considered high risk.
And just to add on to that, on the last slide, one of the things we were showing was, the fact that this is something that's available directly through our website. We do a direct link to this liquidity section through the MD&A. It's based and hosted. We're not going to make you go back to the SEC file. It's part of the report. To the same extent, one of the nice things about browsers today is this Control F function where you can do this kind of analysis. So, a lot of the methodology that we're laying out here are the same things that we do internally when we do deep dives on businesses. we'll go into that MD&A and actually search for these sorts of terms to make sure that they're not necessarily there, because that's an indication to us that we really need to start digging in a little bit more on this business. So the best practices are not only just based on our own, our own analyst factors, but also those we get from practitioners that are very, very, very sophisticated. And this is typically done, across the board. Certainly on the investment side, a lot of times within the banking sector. If you're going in for any sort of a bank loan, it's almost unheard of that you wouldn't be looking at the entire 10K, 10Q filing to make sure that you're covering yourself.
And lastly, there's also 5 key financial items that you also want to highlight when you see a company in the high risk zone. On our snapshot page, we make commentary about any company's total liabilities to market cap trend. In the performance section, you want to take a look at interest ratio. If it tends to be below 1.5x, that's going to be a problem. From liquidity side, you're looking at cash ratio declines below 0.25 and quick ratio declines below 0.60. And then leverage, total debt to assets exceed 30%, especially above 50%, you definitely have some trouble. So it's interesting when you look at the past couple of slides as far as key terms, comments in the MD&A, or impact of key ratios. There's been several examples of companies that have filed for bankruptcy where the MD&A really highlighted that this was a strong possibility and almost inevitable. So we're going to take you through some of the companies and their commentary, so you can see these in real-time examples. So I think the poster child for a lot of this started last year with FTD. Some of the comments here made about liquidity and going concern, and then in closing here, substantial doubt in our ability to continue as a going concern. This was disclosed 7 months before bankruptcy. The Frisk score was a 1 well in advance, and you can see on the right-hand side some of the performance ratios that should have been really investigated, which will also have been a leading indicator of the potential trouble with this company. And then same for JCPenney. This was a matter of, will JCPenney file for bankruptcy? It was more a matter of when they will file for bankruptcy. But you can see they were highly leveraged, $3.7 billion in debt. And again, same story here. A lot of the key ratios indicated this trouble going forward. But I think the most fascinating example would have to be Weatherford International. And I'm going to turn it over to Mike Flum because he spent a lot of time investigating this company and has some really neat comments on their performance.
Thanks, Chris. Well, obviously, this is now 11 months prior to their bankruptcy. And, again, this is now a stretch back because we're going to be looking at an international example that's also filing. But certainly oil and gas was under a lot of pressure during this pandemic due to closure. And, you saw a bunch of bankruptcies in the sector. But Weatherford represents, exactly like Chris was saying, a particularly unique case. So this is 11 months before. They're already talking about some of these terms like amending their, particular credit functions, whether it's their revolving credit agreement or a second lien. These are the kinds of things that are happening a lot more within the levered loan markets. You'll be able to negotiate out of covenants, but these are indications that there might be an issue. And they're clearly calling out liquidity 11 months before in that 10Q from 630. At the same time, you're looking at interest coverage. Obviously, it's below 1. That's indicative of zombie company, so clearly a problem. I think you look at the cash ratio. It actually goes up. Believe it or not, we'll show you kind of as they get closer to bankruptcy. It goes up, but it's still below that line. And then the total debt to assets. There's a problem when you're looking at it that way. They're having to really cover almost 1x, right, at that point. So, Nick, if you jump over to the next slide, this is now from the filing right before they went bankrupt. Obviously, the Frisk now has dropped to a 1. They're actually saying that they really don't think that they have sufficient liquidity to service their debts and obligations. And again, you're seeing the same note about substantial doubt about our ability to continue as a going concern. So number one, I would say, if you're going to be looking at anything in the MD&A, first thing to search for is going concern. If you see that mentioned, that's a red flag. do whatever you can, do some more research, because going concern as an indicator obviously is one of those high red flags that needs to be looked at. As I mentioned, their cash ratio actually improved, which is not something that's totally unheard of for public companies. They're trying to raise money to kind of increase their runway. But at the same time, you can see this total debt to assets went up as well. So, that's actually indicative of the fact that they were able to raise some additional capital. Same sort of an indication there, total liabilities to market cap are now exceeding 5 times. So the stock is actually dropping out now as investors are reading this filing and saying, well, pump the brakes. We really need to take a closer look. So this is kind of another instance of why the FRISC score involves things like the stock market component as a function, because just by proxy, if the stock market is saying that there's a problem with the stock and they're starting to trade out of it, number one, it limits some of the liquidity options available because they can't do things like pipe financing, going essentially on a private equity function for finding capital. But additionally, too, it's letting you know that there's less optionality. I can't go to the market. I can't issue equity. Once you get close to that book value. And we talked about this a lot when we were discussing the Merton model in the last one with Camillo, because it's really a really great indicator that there's a problem coming up. But either way, this is disclosed again 2 months before bankruptcy. So kind of stuck in that period where you really were going to be trapped as a creditor, but to the same extent, there were indicators, there was blood in the water, if you will, prior to this, at least 11 months prior to this, if you were looking at the MD.
All right, gentlemen, before we go and talk about private company solutions, we have our next poll question. So we are asking everyone, do you collect confidential financials on private company counterparties? Leave that open for a minute.
While you guys are answering that, we just got our first question, and I accidentally mentioned I would answer it live instead of in the chat, but I'll just talk to it. No, in general, looking up a company does not indicate a negative response for the FRISC score. We spend a lot of time looking at relative click patterns, and number one, it has to be an aggregate grouping. So it's not just one person looking it up; it's the mass of our user base, and they have to be looking at depth and breadth within a report. Just going ahead and checking out the snapshot isn't going to be an indication that there's a higher consideration of risk. I mean, take the example of, for instance, like Amazon. I don't think anybody thinks that they're going out of business anytime soon. But, most people look at the Amazon webpage, you're going to see a FRISC score of, I think it's a 9 or a 10, and, they're making their payments. It's a little bit, they can stretch people because they have that buyer power. But to the same extent, nobody's going to go and do additional looks up on Amazon in comparison to maybe looking at a company that does have a negative FRISC score. All of a sudden, you'll start going into the financials, start looking at the stock market, maybe check out news, things like that. But we do a lot of normalization to make sure that we're not sending out a signal on that prematurely.
All right, and just with the poll, it looks like about a 60-40 split, 59% yes, 41% no. Carry on.
Yeah, thanks for that poll, Nick. I think that actually is an improvement from what we've seen over the past couple of years, which just plays into some of the activity we've seen over the past, 8 to 10 months or so from our subscriber base. I mean, traditionally, the collection of private company financials has been a really great fit for procurement professionals because they have that buyer power when they're in a bid with a potential supplier. However, in light of the recent events and concerns regarding liquidity and working capital restraints, we've seen our credit subscribers more successful than ever in obtaining financials on privately held companies when they inquire about them or ask for them. So on the screen, what I'm showing here is really just the basic information you would need to apply a FRISC and a Z-score to a private company, assuming you're able to get those financials. And this does a lot of powerful things for our subscriber base. Number one, to reiterate some of the points you made earlier, financial analysis is going to be paramount to any kind of payment-based model in the marketplace, even our own. And secondly, what we find, and this is the direct feedback from one of our subscribers as early as the other day, they said that it allows us consistency across our monitoring tools. So instead of having to toggle between what's Frisk scored, what's PACE scored, what's DVT index scored. They know that a vast majority of the information they're looking at is Frisk scored, and it allows them to make quick, swift decisions based upon that model. It also allows them a higher level of comfort because that Frisk score on privately held companies is over 90% accurate, even though it's just leveraging the financial components. Now, in the event that you're not able to obtain financials, I've heard the horror stories from so many of you, how you go to a client meeting and they won't let you bring a piece of paper or a pen in. You have to kind of memorize quick ratios or numbers and take them back out to your car and write them down as quickly as you can and make a decision. In the event there, then the PACE score is very reliable. Again, over 75% accurate. To put that into context, the Altman Z double prime score, which uses financial analysis on public companies, is roughly 80% accurate. So this score is reputable. It's reliable. It's caught many surprises for our subscriber base. Even received notes in the spring and summertime about, hey, some of your competitors didn't even consider this company high risk. You guys had it pegged and predicted the bankruptcy. You saved me. Thank you. So it's always great to hear that feedback. So again, going back to this waterfall approach, obviously, if you can obtain a Frisk score on a public or a private company, that's going to be your best bet. If that's not available, leveraging the PACE score is extremely important. And it's such an advantage to use the PACE over a payment-based model because, again, to Mike Flum's earlier points, this is a forward-looking predictive model. This is not something that's summarizing past behavior and making assumptions based upon how someone has performed in the past. It's taking all that data, putting it into the artificial intelligence neural network model, and picking up on relationships and data that the human eye can't comprehend or even see, and predicting that information out. So this is an extremely powerful, model to consider when financials aren't available.
So guys, before we talk about trade, we do have our final poll question. I'm going to launch that now. And we're essentially asking you as a bookend, talking about private companies, do you know what percentage of your customers or suppliers are public versus private? You have about 30 more seconds. And at the end, about half of you said yes, 42% of you said no, and 5 strained souls said it never crossed my mind.
Thanks, Nick. So this is a really important question to consider. Let's just talk about the set of public companies around the world. You're looking at roughly 57,000, let's call it 60,000 round numbers. And if you look at just private companies in the US alone, there's at least 25 million by the latest government statistics that I've seen. So just proportionately, you would assume that private companies are such a big concern. I need to have information on privates because that's going to be most of my customers. But again, what we found is once our subscribers become trade contributors, that well over 50% of their actual dollars at risk are actually affiliated with public companies. And that could only be 10 to 15% of their total account or customer base. But that 80-20 rule, goes into effect. And it's really a reason why we drive the importance of the Frisk score home, because even though it might only be 20% of your customers, it's a substantial amount of your exposure and AR, usually your biggest clients. One of the ways we help with that is sharing trade. Now, there's institutional benefits to sharing trade, which I want to touch on here because I think it's important, and then I'll show you in a future slide some of the immediate benefit you get from the day you start contributing, how it can really change the scope of your credit process. But from an institutional standpoint, some of the best feedback we've received are from CFOs or global directors of credit who have this obstacle where they may have acquired companies in the past or been acquired by a company, or credit is decentralized, and they're really unable to find a better way to consolidate and understand what their global exposure is to any given client, or what exposure they have to subsidiaries of a parent company that they're dealing with. So through trade contribution, and some of you on the phone maybe actually have experienced this already, we can take files from separate areas of your business, bring them together, and consolidate the results of those files, meaning we can consolidate the overall exposure. We can look at payment behavior across the entire board for one customer. You can then begin to normalize your credit limits. We've heard horror stories where one arm of the business extends in $1 million credit limit and it's at capacity, and the other arm of the business wasn't even sure that was happening, and they extend. So now all of a sudden, instead of having $1 million capped, you have $2 million capped, and it causes concern if that company goes into the high risk zone. So that's one way we can help. The other way we can help, which is this is brand new, but the response has been overwhelming, and I'm going to turn to Mike Flum in a moment on this, but we also find that trade contributors leverage our reports to help create bad debt reserves, which has folded into this trend of CECL compliance that seems to be being rolled out over the next year or two. And we've had countless conversations with clients about how we can help them here, and all of it has been positive. So, Mike, I just want to give you the floor to talk about your experience with the CECL protocol so far.
Yeah, I mean, I'll go quickly since we're running out of time here, but certainly CECL is at the top of everybody's compliance list. And one of the things that I kind of want to highlight is, again, this gets back to that point of us being, one, a third-party data source, which is required, and two, forward-looking in our predictives. Right, the Frisk and PACE are both forward-looking analytics. And the cool thing about the trade program is that, it gets out of that distinction between the quantity of counterparties and the actual AR balances associated with counterparties. And we'll show you on some of these future slides, some of the graphics to make that a little bit clearer. But the point is, what we can do is actually on the back end, use the actual probability of bankruptcy that comes out of the score associated with your counterparty, not the 1 through 10 rating, but the actual true probability from the model to give you an accurate expected value of what that bad debt reserve needs to be. At the same time, we're giving you an example, we're giving you a check, we're telling you, is what you're reserving correct relative to what we're seeing in our scoring. In the case of the Frisk score, it's 96% predictive or better. So this is generally a pretty good indication of what the risk might be going forward. But the nice thing about that is, one, it gives you that indication if you're under reserving and you have excess exposure that you're not accounting for. But we also see indications of the situations where people are over reserving. And then this represents kind of an interesting option for people, because at that point you're misallocating capital that could be going towards your working capital, right, rather than being tied up in an account on your balance sheet for bad debt. So these are other ways to kind of, increase your not your leverage, but increase your kind of almost efficiency in the use of your balance sheet.
Thanks, Mike. And I'm going to hit on the next few slides quickly. I want to really open up to questions, but just to Mike's point about the visualization of how we stratify the dollars, here's some examples of a trade file where you can see 61% of it's Frisk scored, and you can dive down and identify which dollars are affiliated with which risk levels. And on the next slide, we do the same with the PACE score. And, just the last point on trade, there is immediate impact from a collection efficiency standpoint. We collect over $2.2 trillion in annual receivables, millions of experiences, and our subscribers have commented that it's allowed them to gain insights on how they're being paid versus how others are paying them. So on the first example we're going to show you is just a very basic slow payers report, slow payer being defined as anyone who pays 21 or more days beyond terms. And you know who your slow payers are, but what you might not have access to all the time on demand is comparatively how they're paying everybody else. So you can see here in the column titled Comparative Monthly, there are plenty of situations where they're paying you slower than they're paying everybody else. But the most fascinating report, and this is actually designed by one of our subscribers, a really brilliant guy that I've gotten to know over the past couple of years, the hidden slow payers report. And this is especially important for privately held companies. But there's going to be plenty of instances, if you consider the caliber of companies that CreditRiskMonitor services, where our customers are the strategic or sole supplier of a very, very important good or service to their customer. And they're going to get paid on time, come hell or high water, right? But comparatively, identifying that those companies are paying other trade contributors poorly is a sign of a working capital crisis or financial distress with that subject company. So again, going back to this cloaking idea, you can't always be, take for granted that you're getting paid on time. You need to pay attention to other metrics in the marketplace that may help you identify risks that you may not be aware of. And then lastly, we've seen a huge uptick in integration discussion. And I mentioned the example earlier of one of our clients having this data pushed to their revenue teams to help prospect better. We have plenty of procurement users who are integrating this information so their buyers and commodity managers are aware of the financial distress as a leading indicator of a severed or fractured relationship. But this all came about because many of our clients came to us and said, Chris, Mike, we want this data to get to key stakeholders in an efficient way. We can't necessarily have everybody have a password because they don't want all the bells and whistles. They want the frisk score, they want the PACE score, they want these items. So a lot of what we've designed here is the ability for our subscribers to pull in these key data points into their SAP system, Oracle, Get Paid, High Radius, Vectran, even homegrown systems, or even some just pulling this into like an Excel file via an API. And it's allowed, key stakeholders to be in the loop. It's allowed for efficiency, especially a lot of the budget restraints and hiring freezes that everyone's encountering. It's allowed scalability, the ability to kind of publish this information internally and have everybody on the same page. And then that's all supported and the loop is kind of closed again because of all the access we give and explaining the frisk score and the methodology behind this information. So, this is a trend that we see growing. We were grateful to be a part of that growth for a lot of our subscribers. And a lot of this stuff is really dictated by rules. When the frisk score hits 5, this is what happens in our system, and it sets off a series of events. So in a way, it's very customizable. From a technical aspect, just one statement I'll leave you with, our API is platform agnostic. So, most of the time when the IT professionals of our colleagues look at this information, they find it very easy to use, and implementation is actually surprisingly very fast. That's the feedback that we've received. So, this is another way to leverage our data throughout your institution and really keep everybody in the loop on the financial risk of your counterparties.
All right, guys. Well, Chris and Mike, thank you for leading such a wonderful program. We are rapidly approaching the top of the hour. We want to be respectful of everyone's time. We can hang out for a few extra minutes. You do have the option to submit a question if now that we're done with the program. If there's anything else that you would like to know, we'll be here to answer. I think we've answered a handful already. And this is a reminder too, if you'd like to contact us, or maybe you think of something, later on in the afternoon, we can provide you contact information upon request, and we can answer you on a one-to-one basis. So, we'll leave it open. But beyond that, and it doesn't look like we have anything right now, just wanted to give you guys also a reminder at the very end here. If you did miss our webinar 2 weeks ago with Dr. Camilo Gomez, when we send you guys an annotated version of this deck, there will be a link where you can access the replay. It was a wonderful hour that we spent with our SVP of Data Science, and it really set up a lot of the talking points that we talked about today, bounced off of that. So definitely highly recommended if you weren't, privy to that first one. And if you guys are here for this is your second webinar of the two and you took in both, congratulations, and we hope you learned a lot. We do have 2 questions that came into Q&A. So one is about the replay. Yes, we're going to send a video. And then another question I know that Mike is typing the answer to, but Mike, if you want to address it.
I'll just answer it direct. Ashley, thanks for the question. Obviously, the total debt to EBITDA ratio is another one that we think is important. We didn't highlight it here, but I think the big distinction that I would point to with total liability versus market cap in comparison is EBITDA is still going to be based upon financial statements, even though it's not GAAP related. the market cap side gets at that differential between book value of equity and actual market value of equity. So it's a way of looking at, something in real time that the investor class is actually, analyzing. So it's a combination of trying to get insights from things that are maybe outside of the financial statement. But I would definitely encourage you to look at total debt versus EBITDA as well. That's clearly a good indicator when you're looking at earnings.
Okay. Well, if we do not have any further questions, we just want to say thank you to everybody. And again, keep on the lookout for a replay and an annotated deck, which should be delivered before the weekend. So on behalf of Mike and Chris, we'll just say goodbye. Enjoy the rest of your week, and thanks for attending.
Yeah, thank you, everybody. Really pleasure.
Thank you, everybody.